All right, let's jump right into it. Today, we're digging into Artisan Partners, ticker APAM. Their recent Q2 earnings call was a real head-scratcher for the market. And honestly, it's the perfect snapshot of the puzzle facing pretty much every active manager out there right now.
So here's the thing. On the surface, everything looked great. They hit a record for assets under management, they beat what the analysts were expecting, and yet the stock did absolutely nothing after the call. It just sat there. And that's the big question we're going to unpack today. What's really going on here?
Okay, let's get into the nitty-gritty. The headline numbers. Adjusted earnings per share, or EPS, came in at 83 cents. Now, that just barely squeaked by the consensus of 82 cents. But the revenue number? That was a much cleaner beat. They brought in over $282 million when the street was looking for something closer to $275 million. So on paper, you'd think, hey, this looks pretty good.
But, like we see so often in this business, the headline numbers almost never tell you the full story. To really get why the market basically shrugged, you have to look at these two competing metrics that are pulling the company in totally different directions.
First, let's talk about the good news, the bull case. Their assets under management, the AUM, hit a record high, a massive $175.5 billion. But here's the crucial part. It's not just the number, it's how they got there. And the truth is, this growth was almost all thanks to the market going up. The classic rising tide lifting all boats.
And that brings us right to the other side of the coin, the bear case. While the market was busy pumping up their AUM, actual clients were pulling their money out, to the tune of a net $1.9 billion. So what you've got here is a classic leaky bucket problem. And that persistent outflow, that's the dark cloud hanging over the stock. It completely explains why investors are staying on the sidelines and why the stock went nowhere. So, how is management responding to this huge challenge? Well, they're not just sitting on their hands. They're rolling out a brand new playbook, and it all starts right at the top with a pretty big change in leadership.
This quarter really was the end of an era. It was Eric Colson's 50th and final quarterly call as CEO. I mean, think about that. He's been at the helm for 50 straight calls, all the way back to the company's IPO in 2013. He's now passing the baton to Jason Gottlieb, and Colson is shifting into a new role as executive chair. This is a really big moment for the firm. So the new CEO, Jason Gottlieb, he used his first call to really send a message of stability. This quote here says it all. The main takeaway is this: the core culture, this talent-first approach, that's not going anywhere. But what is changing is where they're pointing all that talent. And that focus on thoughtful growth leads us directly to the firm's biggest strategic move right now, a massive pivot into alternative investments. The new game plan is super clear. They want to evolve. They don't want to just be known as a manager of concentrated public stocks anymore. They're building a more diversified platform that's, and this is the key phrase, fee durable. What does that mean? It means alternatives bring in assets that tend to stick around longer, and they come with higher, more reliable fees. And that's exactly the medicine you need to fight back against those outflows we saw in their public equity funds. And what was really interesting on the call is that management got surprisingly specific about what they're shopping for. They're not just throwing around buzzwords like alts. No, they're actively looking at value-add real estate, which they think is fragmented and ready for a new approach. They called out private equity secondaries, noting that those deals can return cash to investors faster, which is great for the wealth channel. And in private credit, they're smartly avoiding the super crowded areas and instead focusing on unique spots like asset-based lending. Okay, so we've looked at the numbers, we've identified the core problem, and we've laid out the new strategic playbook. So that brings us to our verdict. What should you be looking for as we head into the next earnings call?
The whole story for APAM right now really just boils down to this: a balancing act between catalysts and risks. The bull case is pretty straightforward. If they can finally stop the bleeding and stabilize those flows, if they can show us some real progress on building out this alternatives business, if they win some of those emerging market deals they talked about, and if they can get compensation costs under control, this stock could really take off. But, and this is a big but, the risks are just as real. If the outflows continue, if they mess up an acquisition, if fee pressure gets worse across the industry, or if the whole market just takes a dive, those are all major headwinds. So when you weigh that strategic ambition against those really stubborn outflow challenges, our rating for Artisan Partners is market perform. The plan makes a ton of sense, the ambition is definitely there, but until we see some hard evidence, some real proof that the outflows are stopping and that this alt strategy is actually working, the execution risk is just too high to give it an outperform rating. It's a show me story for now.
All right, and that brings us to our final segment. This is where we lay out a trade idea that's, let's say, a little wild but totally plausible. Today's idea is called the Alts Alpha Arbitrage. So the core idea here is simple. We think the market is too focused on Artisan's old problems and is undervaluing its new strategy. So this trade tries to isolate that specific potential. Here's how it works. Step 1 is the long leg. You buy APAM stock, and maybe you add some call options for extra firepower to bet on their big pivot to alternatives actually working. Step 2 is the short leg. You short a financials ETF, something like KCE. This is your hedge. It protects you from the headwinds facing the entire industry. The goal here is to capture the alpha, the outperformance from Artisan's specific execution, and separate it from what the rest of the market is doing. So there you have it. That's Artisan Partners, a company at a really critical turning point. The big question for the next quarter is crystal clear. Can this new strategy plug that leaky bucket before the market completely loses patience? That is exactly what we'll be watching. And as always, please remember, this is not financial advice. Be sure to do your own homework.